Okay, let's unpack this. We're jumping straight into energy transfer today.
Right?
And if you've been watching the charts, you've probably seen the unit price just, holding steady in that mid-16 to mid-$17 corridor.
Yeah, it's been pretty stable.
But honestly, that price action is almost a decoy. The real story here, the thing that's really surprising, is where the new growth is coming from.
That is precisely it. Everyone gets fixated on the daily swing, but you have to look deeper. You have to see how this massive infrastructure player is repositioning.
Repositioning for what, though?
For totally new secular growth. Specifically, and this is the fascinating part, how it's supporting the rapid, almost explosive expansion of AI and data center infrastructure.
I find that amazing. You think of a huge pipeline company, you think oil, you think gas volumes. But now the company's actually talking about how their system is, and I think I'm quoting here, powering AI growth with infrastructure support. That's a fundamentally different story.
It absolutely is. And you're tuned in to a discussion designed to make sense of the market's biggest moves. We're here to give you the critical high-value facts that actually drive value, without all the usual noise.
And if you're enjoying this, look at what's really going on. Please make sure you subscribe and engage. A simple like or a comment, it really does help us a lot. Lets us bring you the next breakdown that much faster.
All right, so before we get into all that growth, let's just set the table. We need to establish the sheer scale of this operation.
Okay.
Energy Transfer is one of the biggest, most dominant midstream operators in the entire U.S.
Wait, let's pause right there. Midstream operator. For anyone who might be newer to this space, what does that actually mean? In simple terms.
Excellent point. Okay, so midstream is basically the transportation and processing layer. They sit between the wellhead, where oil or gas gets produced, and the end user, like a refinery or your local utility.
They're the toll roads of the energy sector.
That's the perfect analogy. They're the toll roads. And to understand the scale, just look at the revenue. Last fiscal year, this company generated somewhere around $89 to $90 billion.
$90 billion.
Yeah.
That's bigger than the GDP of some small nation.
It's an enormous enterprise.
And that size, it's not just about revenue, right? It translates directly into what people call a moat. What's a competitive advantage here?
The moat is the network itself. It's the sheer integration and, honestly, the replacement cost. They own thousands and thousands of miles of pipelines, processing plants, and they span all the key U.S. basins.
The Permian, the Marcellus.
The Permian, Marcellus, Utica, and critically, the Gulf Coast. That's the heart of the export market. Nobody could just go out and build a network like that today, not quickly.
And that network gives them incredible stability, doesn't it? Because they're not really riding the wave of, the volatile price of a barrel of oil.
That's the most important thing to understand about their financial strength. About 90% of their cash flows are completely insulated by long-term fee-based contracts.
Okay, so what does fee-based mean in this context?
It means they're either take-or-pay contracts.
Right.
The customer pays, whether they use the capacity or not, or they have minimum volume commitments, so they have unparalleled visibility into their cash flow.
So that foundation is rock solid, but they do carry a lot of debt, which is, pretty typical for these big infrastructure companies. How does management balance that debt load with that high distribution yield, which is sitting around 8.5% right now?
They do it through very disciplined leverage targets. Management's priority is maintaining a specific metric, their debt to EBITDA, at around the mid-4 times range. That's the signal they send to the market.
And for anyone not familiar, debt to EBITDA is just dust. It's telling you how many years of cash flow it would take for the company to pay off all its debt, right?
Precisely. It's a key measure of financial health. And they've been actively working to reduce their absolute debt to get that number back into their target range. That's critical. It signals stability. It helps keep their borrowing costs down.
Okay, so that covers the defense, the solid foundation. Let's shift to the offense, the bull case, because that's where the surprise is. The top-line revenue might be stable, but the adjusted cash flow, their EBITDA, is actually growing faster. What's driving that?
It's all about high-value processing and exports. They are really scaling up their NGL, that's natural gas liquid exports, and their fractionation services.
NGLs, that's not just regular natural gas, is it?
No, these are the valuable components that get stripped out of raw natural gas. Think propane, butane, ethane. Fractionation is just the process of separating them. And these are really high-value products.
And global demand is high for those.
Massive. So Energy Transfer is benefiting hugely from that global demand for U.S. exports. They're just getting better margins out of the systems they already have.
And that margin expansion is what's feeding this growth story. The consensus out there is calling for mid-single-digit annual EBITDA growth. But if you look at earnings per share, analysts are projecting growth averaging, what, 11 to 12% a year between 2025 and 2027.
Yes, and that double-digit expectation is what could fundamentally change the investment case here.
But hold on a second. We're talking about a giant, established, almost utility-like company, 12% annual bottom line growth for 3 years. Is that realistic, or is that just Wall Street being optimistic? Where is that actually coming from?
That skepticism is fair, but the momentum is coming from two very real, tangible drivers. And the first one, the most compelling, is that AI catalyst we mentioned at the start.
Tell me more. How does a pipeline company actually feed an AI data center?
Well, these data centers, especially the hyperscale ones for AI, need just vast amounts of continuous, predictable power.
And the grid can't handle it.
The grid simply cannot handle the load in many places. So natural gas is really the most viable option right now to meet that insane surge in demand. And Energy Transfer is directly securing deals to transport that gas to these new power sites.
So they're literally building the energy arteries for the digital economy.
Exactly. We're talking about contracts for around 1.5 billion cubic feet per day of capacity, just for data center deals. This is a brand new additive demand driver.
And the second driver is more traditional but still growing, the exports.
Correct. They are just perfectly positioned for that Gulf Coast footprint to benefit from rising U.S. hydrocarbon and NGL exports. We're seeing it with projects like the upsized Transwestern Desert Southwest project. They're boosting its capacity up to 2.3 billion cubic feet per day.
So when you combine that safety moat with that double-digit growth potential, that's where the re-rating argument comes from. The unit has been trading sideways, low volatility, but Wall Street targets are clustering around 21, 22.50.
Which implies a pretty significant upside, maybe 25 to 35% from where we are now. And, look at what the insiders are doing. They seem to believe it. We saw a director just recently buy 1.35 million units.
Whoa.
That kind of insider commitment, that's a massive signal of confidence.
It's a huge vote of confidence. But let's be balanced. We have to talk about the risks. What's on the other side of the ledger for investors to consider?
The primary risks are really around the debt and the financing, especially right now with high interest rates. The absolute debt load is large, and higher rates could, put a squeeze on the distributable cash flow after they make their interest payments.
And that connects to the big red flag a lot of new investors see, that high payout ratio. Calculated on net income, it's over 100%. That just screams unsustainable.
This is a critical point, and we have to clarify this.
Yep.
Because this is where the accounting for these partnerships is fundamentally different from a regular corporation.
How so?
Because of depreciation. Yes, the net income payout ratio is high, but that metric is really misleading for this sector.
Why?
These pipeline assets, they cost billions upfront, but then they get depreciated on the books over decades. So depreciation is this huge non-cash charge against net income.
Yeah.
So they can have very low net income even when cash is pouring in.
So management's argument is that the distribution is safe based on free cash flow, or FCF, which adds back that non-cash charge.
Exactly. You have to look at the distributable cash flow, the DCF. The coverage is much, much safer when you measure it that way. It's a nuance of the industry, but it's a high-value fact you absolutely need to understand.
Okay. Beyond financials, what about execution risk on big projects?
We have to talk about the delay of the final investment decision, the FID, for their huge Lake Charles LNG project. It got pushed out to 2026.
And delays on mega projects can mean cost overruns, inflation.
All of the above. And you can never forget the perennial challenge for any pipeline company. Regulatory hurdles and community opposition. That always impacts timelines.
But how do they mitigate those risks?
Well, context is key.
Yep.
Their core cash flow, that 90% we talked about, comes from their existing diversified assets. They are not dependent on any single new mega project, not even Lake Charles, to keep the lights on and pay the distribution.
So delaying Lake Charles, while maybe a setback for that huge growth story, it actually has a silver lining. It preserves their balance sheet right now.
Precisely. They're not sinking billions into a project that isn't fully locked and loaded. It's risk management. They're prioritizing stability, reducing leverage, and that makes their foundation even stronger.
Okay, so let's look ahead. What should listeners be watching on the Catalyst calendar for the next, say, 3 to 12 months?
The next big scheduled event is the quarterly earnings release, which should be around February 10th, 2026. That's where you'll get crucial updates on volumes, especially those NGL and export volumes, plus confirmation of the distribution coverage and where that leverage number is heading.
And what about unscheduled news? What could pop up and really move the needle?
Anything related to that Lake Charles LNG project, any acceleration of commercial agreements or regulatory clarity ahead of that 2026 FID would be an immediate material positive catalyst.
The market would love that.
Oh, absolutely. Also, keep an eye on any more updates related to data centers and AI. Securing more big contracts there will really cement that new growth narrative.
And the macro environment, specifically interest rates, that's still key, right?
Absolutely. Lower or even just stable interest rates would be a huge tailwind. It makes a high yield, like the one Energy Transfer offers, just so much more attractive compared to safer bonds, and that draws in a lot of capital.
So to wrap this all up for you listening, the core thesis here is that Energy Transfer offers this high-yield growth plus income vehicle. It's supported by its massive scale, its asset quality, and now these very real, tangible growth catalysts.
It's a compelling mix of defense and offense. The existing system is the safety net with those fee-based cash flows, and then the emerging AI and export connections offer this meaningful double-digit growth optionality that, frankly, you don't normally find in this sector.
Now, for a final thought for you to consider, Energy Transfer's network is this web that links hydrocarbon production to key export hubs all over the country. Given the company's new focus on powering AI growth, you have to think about the long-term energy implications of this whole digital boom.
The future demand for natural gas from these massive data centers, it's projected to be enormous. And, importantly, relatively inelastic. They have to stay on.
So the question to ponder is this. Will that new structural demand from tech ultimately become a more significant, more powerful demand driver for midstream infrastructure than traditional residential or commercial use? That's the shift we are starting to see. And it positions a company like Energy Transfer right at the heart of the modern tech energy ecosystem.
Something to think about. We appreciate you tuning in.
Absolutely. Don't forget to subscribe so you don't miss our future breakdowns. We'll catch you on the next one.